This is the current federal tax developments for the week of December the 1st, 2025. Current federal tax developments are brought to you by your state society of CPAs. Med Zollers, and this we're going to be talking about a few things that have been going on during the week. In fact, we had quite a few things for what's a relatively short week. So we're going to talk about issues of whistleblower awards and what is a substantial contribution to the IRS investigation. The IRS published regulations on the corporate stock repurchase excise tax. Right, so we have that. We're going to look at some developments on judicial review of willful FBAR penalties. Going to revisit the profit motive standard when the tax court decides to take up the taxpayer's request for reconsideration of the opinion following the Loper-Bright decision. We're going to talk about the judicial precedent on the erroneous refund recovery rules and how a taxpayer is going to kind of get stuck, not surprisingly, with not being able to file suit to try to claim a refund. We're going to have OBBBA guidance on SFCs and the Section 987 elections. Talk about OBBBA scholarship tax credit discussion. The IRS is stated they're going to be issuing proposed regs, give us some idea about what those regs are likely to contain, and also request for guidance. And finally, the tax court is showing its frustration with conservation easements and gross valuation misstatements. Suffice it to say that this case didn't start out well for the taxpayer when he started reading the opinion, and it didn't get a whole lot better as we go through it. But let's talk about the case of Tom Prescott versus the Commissioner of Internal Revenue. Tax Court Random Decision 2025-12. Came out on November the 19th of 2025. This deals with a whistleblower award that Mr. Prescott was trying to claim. So basically, we're looking at the substantially contributes hurdle for this office, for this particular issue. In this case, we were having the tax court reviewing the IRS whistleblower office denial of an award under Internal Revenue Code Section 7623B, where you can get an award for being a whistleblower that leads to collection of funds from the parties that you turned in. In this case, Mr. Prescott had filed a claim in April 2013 targeting a foreign financial institution, which is referred to in this case as Target A. The IRS criminal investigation began investigating Target A in October 2010. Now, that, as you can see, is quite a bit in advance, as we're going to discover, of when Mr. Prescott became involved. And there they relied upon the offshore voluntary disclosure initiative information they had received from participants as they investigated that particular financial institution. By March of 2011, the Criminal Investigation Division had already executed a search warrant and had sufficient documentation to trigger foreign treaty requests related to this investigation. Now, Section 7623B1 mandates that it be a 15 to 30% award only if the IRS proceeds with any administrative or judicial action based on information brought to the Secretary's attention. Secretary obviously being the Secretary of the Treasury. Now, the tax court reviews the WBO's determinations under the Administrative Procedures Act, and they're looking for an abuse of discretion. They don't review it de novo. They don't start from scratch and review. They're just saying, did they abuse their discretion? Now, under Treasury Regulation 301-7623-2B, the information that Mr. Prescott provided must substantially contribute to the action that led to the collection of funds. Now, substantial contribution defined per the reg, it means the IRS must initiate a new action, expanding the scope of an ongoing action, or continue to pursue an ongoing action that it would not have but for the information provided. So this is a but-for standard. If Mr. Prescott had not come forward effectively, would the investigation have collapsed? Or would they have been unable to do some new part of the investigation and get money from it? Now, what the Treasury Reg requires, 301-7623-4C4, requires evaluating the contribution of each individual when there are multiple claimants asking for a whistleblower award, as there were in this case. Now, on remand, because it was sent back because it didn't document things correctly per the tax court, the WBO determined that the other whistleblowers, whistleblower 1 and whistleblower 2, were responsible for 100% of the collected proceeds from Target A. In essence, what Mr. Prescott provided was, by that point, already known. It was pre-existing knowledge to the IRS. and it did not lead to the critical 2011 search warrant or subsequent tax treaty requests. So, since the investigation was already formalized, major evidence gathering steps were underway before Prescott's 2013 submission. He failed the substantially contributes test, thus didn't qualify to participate in a whistleblower award. Now, Mr. Prescott argued the Department of Justice's willingness to meet with him indicated his information was helpful, suggesting it was leverage in negotiations. I offered this up and they had me come and talk with them. So that must mean they had a use for it. But the court said no. Department of Justice or other investigative agencies are going to be expected to meet with all credible sources during a criminal investigation. That meeting does not prove that the information obtained from that, interview with Mr. Prescott substantially contributed to the ultimate recovery. It was just, making sure that we're not missing something we don't already know. So the Department of Justice input, how did that impact things? It said the WBO did not abuse its discretion by failing to obtain information the Department of Justice declined to supply due to grand jury secrecy rule, Rule 6C, and various privileges. That, in essence, if they had to do that, then we're going to violate and blow the whole thing. No, we got to keep things together. So finally, the court found no evidence in its administrative record that suggested that the factual findings of the WBO were clearly erroneous. And since that's what they're looking for, abuse of discretion, they abused the denial in this case. Next up, we have final regulations for the corporate stock repurchase excise tax. This is Treasury Decision 10037 that came out on November 21st, 2025. Now, what you may remember is in the Inflation Reduction Act in 2022, there was a 1% excise tax imposed under Section 4501 for certain corporate stock repurchases, right? Now, these regulations are effective as of November 24th, 2025, as these take regulations final. Now, this affects domestic publicly traded corporations, get that right, which is called a covered corporation if you're reading the regs, and their specified affiliates. Now, the definition of a repurchase includes a Section 317B redemption or any transaction that is deemed to be economically similar. And there's a specified affiliate rule, which is the acquisition of a covered corporation stock by a specified affiliate from a non-affiliate is treated as a repurchase by the covered corporation. So, essentially, you can't get around this by having an affiliated company do the repurchase. Now, here comes up the tax base issues. We got this calculation base and what are going to be excluded instruments under these regs as finalized. There were proposed regs. These regs make some significant changes to the proposed regs. Now, the tax base is calculated on a gross repurchase amount, which is reduced by statutory exemptions found at 4501E of the code and the netting rule found at 4501C3. Defining how those apply is obviously a crucial part of this. Now, valuation, fair market value is, per the reg, determined to be is market price on the date of repurchase, which is generally the trade date for any regular way sale. And what we have is excluded stock. These stocks are treated as more akin to debt, and so repurchasing them does not trigger this tax. And that includes Section 1504A preferred stock and additional Tier 1 preferred stock, including similar stock issued by certain farm credit system entities will be excluded. Now, let's talk about transactions not treated as repurchases, one of our key definitions. This is at Regulation 58-4501-2E5. And the tax does not apply to transactions that fundamentally restructure ownership. That is, redemptions where the covered corporation ceases to be a covered corporation, a leveraged buyout, distributions in complete liquidation under 331 or 332A, or acquisition of stock by the target corporation in an acquisitive reorganization under 338 will not qualify. And economically similar transactions, which is an exclusive list under the regs, for e-reorganizations, only to the extent stock is acquired in exchange for non-permitted property, is that considered to be a repurchase. And for split-offs, acquisition of distributing corporation stock in exchange for property would be those economically similar transactions. And as this is the exclusive list, other things don't float in. Now, there is a de minimis exception found at 4501E3. It exempts the tax if the total fair market value of stock repurchased does not exceed $1 million. And that's determined before other exceptions or netting. So that, in essence, you might have less than $1 million that's going to be applied to, but you're going to first kind of do a gross calculation, see if we're over $1 million, and then be able to reduce that down. Now, that reduction applies if the repurchased stock or stock of equal value is contributed to an employer-sponsored retirement plan under 4501E2. There's also a dividend exception at 4501E6. And that means the reduction applies to any redemption treated as a dividend under 301C1 or 356A2. Now, to get that exception, there must be sufficient evidence to rebut the presumption of a non-dividend equivalence of the transaction. Finally, the netting rule at 4501C3. Gross repurchase amount is reduced by the stock issued in connection with services to employees or other service providers. And these issuances, generally disregarded for netting, include stock distributions to shareholders and stock withheld for exercise price or withholding obligations. That is a net exercise. Now, there are some special rules for foreign corporations, AFCs, and CFSCs. The tax liability on a 4051D covered corporation for an Apple foreign corporation, AFC, liability falls on the applicable special affiliate, the ASA, that acquires the stock. There is a foreign partnership de minimis rule, and a foreign partnership is not an applicable specified affiliate if domestic entities hold less than 10% of the capital and profits interest of that entity. And the foreign netting limitation, the rule is narrowly defined by statute. The reduction applies only to stock issued or provided by the 501D covered corporation to its own employees. Any stock issued to non-employee service providers is not included in the foreign netting rule. As I say, the final regs are out. If you're involved in this, obviously you need to go get those regs and go through them. This provides a very rough initial glance at what goes on in those regs. Next up, we're going to consider FBAR. And this is the review by the courts of willful FBAR penalties. And this is the United States versus SATM, case number 22CV0731, the U.S. District Court for the Northern District of California, and the opinion was released on November the 20th of 2025. Let's talk about fifth FBAR penalties and the question of, do they violate the Eighth Amendment? Right. So, willful failure to file FBAR authorizes a penalty up to the greater of $100,000 or 50% of the account value. Now, again, that's per the statute, but if the statute is in violation of the excessive fines and penalties clauses there, found in the Eighth Amendment, then it will be overridden by the amendment. Now, taxpayer Sidon was assessed a penalty of $437,564 for willfully failing to report foreign accounts from 2013 to 2017. Now, the maximum aggregate account balance used for the calculation was $875,127, which was the highest balance in 2014. Now, the stipulated income tax loss for those years totaled only $29,006. So Mr. Sidon said that penalty represents an excessive fine and should be reduced under the excessive fine clause of the Eighth Amendment. So the first question is the FBAR penalty a fine that's subject to the Eighth Amendment? Right. So, and the court went to the excessive fines clause test the courts have developed over time and found the sanction must impose punishment, means it serves a retributive or deterrent purposes and not solely a remedial purpose. Now, there is a split in the circuits. The First Circuit has held that the FBAR penalty is not a fine, while the 11th Circuit has held that it serves for punishment. This case would be appealed to the Ninth Circuit. So we don't have really anything there. So in this case, since the court had no guidance from the Ninth Circuit, they sided with the 11th Circuit, finding the FBAR penalty is a fine under the Eighth Amendment, which initially is good news for the taxpayer because it means the Eighth Amendment could come into play. It says their reasoning is the penalty focuses on the defendant's culpability, differentiating between willful and non-willful. So that's bad act. since it focuses on a bad act to impose the higher FBAR willful penalty, that means it's going to be considered a fine. Unlike typical civil tax penalties, this penalty is part of the Bank Secrecy Act also, which is a Title 31 provision, not a Title 26 provision, and is not directly tied to how much tax was underpaid. Unlike most of what you'll find penalties in the Internal Revenue Code, this one is not really tied to the tax paid. Now, we have to say, okay, the mere fact it's a fine doesn't mean you get to knock it down, because now we have to determine, is that fine excessive? And this looks at the proportionality factors that the courts have developed. Generally, the standard must be grossly disproportional to the gravity of the defendant's offense for the Eighth Circuit to override the penalty amount. So the first factor is culpability. And the jury did find that, the taxpayer here had acted willfully. That includes reckless behavior. So there was more than a minimal amount of culpability involved with him doing this. He was trying to avoid the tax, was effectively the ruling of the people there. He knew about it, and he just decided he wasn't going to report this, and he wasn't reporting the income. Now, alternative penalties are compared. There is a criminal penalty that can apply when you willfully violate your reporting responsibilities of $1.25 million in fine and a 25-year sentence in the pen. And the sentencing guidelines based on his $29,006 tax loss would have been a maximum fine of $139,000, which sounds, well, that's good, that's lower, but it would have also been 4 years imprisonment. Now it's a little tougher call whether 4 years in prison, it is worth the reduced fine. It'd be like, is that equivalent? It did say the assessed penalty was 3.1 times greater than the sentencing guidelines maximum fine of $139,000. So that's there. But was that fine excessive? And now they look at the extent of harm. They said the violation caused a specific tax loss of just over $29,000, along with significant investigative resources expended by the government to uncover that shortfall. And they said the key differences is the direct monetary loss differentiates this case from those involving solely informational losses, right? You have to go, you got the tax and you've got information and you got all the money the government had to spend to figure this out. Despite the large ratio compared to sentencing guidelines, the penalty was not found by the court to be grossly disproportional. It said the penalty was significantly lower than the maximum statutory amount, $1.43 million, and was appropriate for deterring the willful conduct found by the jury in this case. So ultimately, the court sided with the Treasury Department and found that the taxpayer, he needs to pay the fine. In its entirety, he needs to pay the FBAR penalty. It's not excessive under the Eighth Amendment. Another constitutional issue arose on a different case, or at least was being reconsidered. This was a case of Schwartz versus Commissioner, Tax Random Decision 2025-122 from November 25th of 2025. Not necessarily constitutional, but Supreme Court ruling. Now, we already had this case described before, right? In this case, in the first case for Schwartz, which is referred to by the court as Schwartz 1, Tecomate Industries, LLC, lacked the requisite profit motive for its farming and ecotourism activity under Section 183. The court found that the farming was not going to make money, and it also found it was separate and apart from any motivation they had for the land underlying it, being a motivating factor in being able to be lumped in with this term and profit motive. Now, they did a lot of referencing to the Chevron standard, right, for deference to the regulation. In this particular case, Treasury Reg 1.183-1. Okay. And obviously, the decision came out before the Supreme Court issued the Loper-Bright decision in the summer of 2024, which overturned the Chevron rule and therefore said Chevron deference was no longer appropriate. Since this case was decided by saying the reg is valid under Chevron deference and you failed under the reg, the tax court agreed to reconsider their decision. because the taxpayers claimed that Treasury Regulation 1.183-1D1 and 183-2B were invalid because they're not the best interpretation of 183. And we've seen a lot of this where we just, say the magic words low per bright. And while it is true that it is not sufficient, and the court was probably correct to reconsider this, when the decision relied so heavily on Chevron deference and didn't really separately justify the standards applied, doesn't mean that merely saying Chevron deference means you win, or saying low per bright. You might still lose the case, right? Low per bright does not mean, hey, whatever the taxpayer said is how this works. And that's going to be the result here. Now, the court agreed to reconsider, but it just found it was unnecessary to address the validity of the China's regulations because it found that even if the regs were invalid, they still couldn't carry profit motive by historic case law. Okay. What they said was, look, these regulations were largely based on case law that predated the adoption of Section 183 by the Congress. As such, the tax court said, we're not going to say where the reg is or isn't valid. We're just going to say it doesn't matter because the Supreme Court says, we should consider instead what the courts have said. And the courts are saying what you did is not going to qualify as profit motive, at least as the tax court applied its determination of the facts compared to the standards that had been previously laid out by the courts. The first thing was the activity question. Whether the undertaking constitutes one or more activities is a question of fact based on surrounding circumstances and case law. In essence, was the holding of the land truly a combined activity with operating the farming? Are they really one big activity? And what the court found was that the farming activity of the LLC, extremely unprofitable ecotourism, was found to be separate from the taxpayers and affiliated entities' sophisticated, highly profitable real estate operations. Yes, they knew how to do real estate. But the key question was going to come down to, did the farm really do anything to help, market this real estate, or was it just something the taxpayers were kind of interested in and thought was a good hobby? It was kind of a hobby thing. They were in it because, hey, they just liked that sort of thing. And the profit motive standard says the activity must be entered into in good faith with the dominant hope and intent of realizing a profit. That intent must be bona fide, even without relying on Reg 1.183-2B. The tax court said they would employ the same factors developed in the pre-existing case law. What was the manner of carrying on the activity, the history of losses, and the personal pleasure elements? Key factor is the court relied heavily on the expectation, or I should say the taxpayers relied heavily on the expectation that the assets using the activity would appreciate in value, meaning holding the land and the farm were to be treated as one activity. The court found those significant errors in the taxpayer's expert testimony regarding property valuation. As an example correction, the expert's 2 times valuation multiple for major water feature was corrected by the court down to a 63% valuation premium based on better comparable data than was used by the expert. And the corrected value after they adjusted down for the flaws they found in the methodology of the valuations that have been submitted, the court reduced the determined value of the La Perla, yeah, I'll get that right, HQ tract and Jalisco Ranch tract significantly. So they found there was not as much appreciation as the taxpayer suggested was reasonably expected to occur on that land. And the catch with this, which made it big, was the entity had reported a Schedule F farming losses from the eco farming tourism, the ecotourism business, exceeded $15 million from 2005 to 2010. And using the corrected appreciation values and assuming a single activity, the unrealized property gains were not even close to covering what they were pouring into this activity and attempting to claim losses on, right? So they said the property appreciated during 2018 to 2020 offset less than 9% of the additional losses incurred in the farming activity during that period. So in essence, a reasonable person trying to make profit off this would realize that if you had to operate the farming activity to get the property to appreciate, you were better just not doing it at all because it wasn't appreciating. It doesn't make sense to lose $15 million to gain what may be a $1 or $2 million increase in the value of the land. That math doesn't math, shall we say. Simple way of looking at it. So the court finally concluded Dr. Schwartz pursued the activity as a long-time passion rather than a genuine profit motive. And the court found that that was a thing to consider. There is a reason why we call these the hobby loss rules, right? The fact they enjoy it. Enjoying it doesn't mean you can't be doing it for a profit. But enjoying it does make it a lot easier to question why you continue to accept these huge losses. You know, if you're not really in it, if you're in it for the money, even if you like doing it, you're going to cut off the losses. But if you're in it just because you want to do it because you personally like to do it, then the losses may be utterly irrelevant. And that's kind of what the court found. The court found the farming activity was not engaged in for a profit, essentially now in Schwartz 2, what they call this case, coming to the same conclusion they did the first time. Okay, let's talk about some people really don't recognize when they've lost. This is Judicial Precedent on Erroneous Refund Recovery. This is the Quinone versus United States Court of Claims case, number 24810, decision entered on November 21st. Now, we've talked about this case before when they lost in a prior year. The taxpayer used a technique referred to as intangibles. And what they did, they would take their actual income and withholdings and multiply them using this weird concept they developed called intangibles. You can go back to the original case, which was for the prior year, and you get this really odd description of this concept of intangibles and how they'd multiply. What it really meant was that they had basically been paid $203,000 per their W-2 actual wages and had withholding of $26,000. But due to these intangibles that supposedly were involved in transactions, really there were $3.6 million of taxable wages. That might sound like a bad trade, but $470,000 withheld. At the end of the day, they kind of worked that out so that they would get a refund at the end of the day of $444,323.86. And it was all based on inflating up that withholding. And they inflated the wages, which, due to the facts on the return, didn't really matter, but inflating the withholding made a big difference. Now, they had gotten that refund and IRS counterclaim for recovery of the erroneous instituted refund plus statutory interest, right? Now, the taxpayers received a CP12 notice or other communication from the IRS that they claimed was implicit approval of their initial $904,000 refund claim. Now, the court rejected that interpretation. It's like, they just gave you a notice of their computation and differences. They hadn't really approved it yet, right? They just issued it, right? They claimed they had made honest mistakes and lacked any intent to defraud. The court said good faith is not a defense to computing the right tax. It may be a defense to penalties, but not getting you out of paying tax. The fact you might have sincerely believed that this crazy intangible accounting method was legitimate is not going to change the tax law. The tax law will apply to you, good faith or not. What may not apply to you are penalty provisions that allow for a good faith defense. Right? And essentially, even though they didn't intend to defraud, it doesn't matter. Right? The refund has to be repaid. You don't get out of it. And the court said, look, the federal tax system largely relies on each taxpayer's self-assessment. And all that meant was the IRS in this case initially incorrectly relied on their bogus figures when they issued the refund. That doesn't make it the final determination, right? In essence, they don't go through a full exam of every taxpayer's return. So, for the erroneous refund recovery standard, the U.S. government must establish 4 elements to prevail. Number 1, a refund of a sum certain was made. Number 2, the tax refund was erroneously issued. Number 3, the recovery lawsuit was timely filed by the IRS to get the money back, and the taxpayers were not entitled to the refund. Now, summary judgment, which is what the IRS is moving for in this case before we get into trial, is warranted when the record could not lead a rational trier of fact to find for the non-moving party, the taxpayers in this case. And the plaintiffs failed to raise any genuine disputed material fact relating to figures that were on a 2020 return. Both the fact that, what was the intangibles number and what was the actual cash, paid over for both wages and withholdings. So, as the court found, the plain comparison of their self-reported W-2BA data, because it was coming from their own company, which is what was also kind of funny, and their actual W-2s confirmed they had misrepresented material facts. Because the IRS based its refund calculation on, as the court called them, imaginative but false documents executed under penalty of perjury, the refund was erroneously issued. Therefore, the court granted the United States motion for summary judgment. They ordered the Quinones to pay the United States $444,323.86, and statutory interest will be calculated from the day of the refund payment, which was March 30 of 2022. The fact that you sincerely believe that you calculate the right tax will not change the fact that you didn't calculate the right tax. Ultimately, the court said that's it. And bottom line, we've already kind of been through this once. Okay, next, we're going to have the 1-month deferral rule. So guidance on specified foreign corporations and Section 97 elections, knows 2025-72 issued in November. Now, the One Big Beautiful Bill Act removed a feature of prior law. Prior to the One Big Beautiful Bill Act, IRC Section 898C2 allowed a specified foreign corporation, SFC, to elect a taxable year beginning 1 month earlier than its majority U.S. shareholder. So basically, assuming that your shareholder is December year end, then we're looking at a November year end for your corporation. You could start, you can basically have a 1 month deferral. So, you start and you're going to skip December. Okay. Now, what the One Big Beautiful Bill Act, Section 7352 of the Act, repealed the 1 month deferral election for taxable years of SFCs beginning after November 30, 2025. Bingo. Beginning after, if you're listening to this on Monday, yesterday, right? This is December 1st broadcast, supposed to be, so we're going to go with that date, right? So, SFCs utilizing deferral have a mandatory 1 month short taxable year as their first required year, right? You're allowed to defer 1 month. You now can't defer anymore. You're going to have a 1 month short year, right? So this does create a potential mismatch where the foreign taxable year closes within the 1 month short year, causing accrued foreign net income tax to exceed U.S. federal income. They're now going to have, these rules are meant to kind of get around that, okay? Targeted corporation, the allocation rules apply only to an affected corporation. There's an SFC that uses the accrual method for foreign income taxes, and it must change its year. The goal is to prevent a mismatch that could result in income loss, potentially precluding a U.S. shareholder deemed paid credit under Section 960 for those taxes. And what is a specified foreign income tax defined is foreign income tax accrued on the affected company's first required year. That's going to be our specified foreign income taxes subject to this rule, right? The rules do not apply to an SFC using the cash method of accounting or foreign taxes accrued in the succeeding taxable year. It's only for that 1 month year accrual basis is what's going to apply. So, having found we have specified foreign income taxes, step 2, the apportionment, is allocate income groups and the PTE tree groups in the first required year by applying section, regulation 1.861-20. That SFIT is allocated for the first required year and succeeding taxable year by using an allocation percentage. And that allocation percentage generally equals a portion of taxable income determined under foreign law attributable to the first required year divided by the total foreign taxable income. In that methodology, the principles of 1.150276B, closing of the books or rateable allocation, are used to attribute the foreign tax base, and allocated amounts are treated as accruing in the respective year for all code purposes. Subpart F, guilty, 960 credits. In the Section 987 context, it governs the foreign currency gain-loss recognition for the qualified business income units with a functional currency other than the dollar. existing election, the taxpayer can elect under 1.987-10 E5II Cap A to recognize that, essentially pre-transition gain or loss ratably over 10 years. So spread that out. There will be a forthcoming modification. New regulations will modify the election to account for short taxable years resulting from the 898 repeal. And new amortization period, pre-transition gain or loss, be recognized ratably over 120 months. That is 10 years instead of 10 taxable years. So going from taxable years to months is effective. It's a 10-year, but it starts with the month, not really just the taxable year, right? And you can rely on rules described in this notice applied consistently and in their entirety, right? So notice issued, you now know how to take care of do that. Next up, the IRS issued Notice 2025-70 issued November 25th. And this is meant to start the discussion about upcoming rules for the One Big Beautiful Bill Act scholarship tax credit. Okay. Now, Section 25F of the Internal Revenue Code was added by OBBBA Section 7411. In this case, there is a non-refundable income tax credits to individuals that make qualified cash contributions to a scholarship granting organization. For those of you in Arizona, this is effectively a federal version of Arizona's private school tuition organization. And I say it's a federal version of Arizona's because Arizona, unlike most of these credits, Arizona's is a dollar-for-dollar credit. And the federal one will be one as well. So we're going to keep that in mind. Now, there are requirements to this. To qualify as this, which we're going to first be able to take in 2027, the contribution must be used to fund scholarships for eligible students solely within the state where the SGO is listed. Right? It is limited to $1,700 per taxpayer for any taxable years, and the credit must be reduced by the amount allowed as a credit on the state return for the contribution. Right? So you can't double dip. Arizona is obvious. You give $1,700 to a qualified tuition organization, qualified private school tuition organization, and let's say Arizona does go along with this, and that would also be considered an SGO. The catch is you can't get $1,700 reduction in Arizona taxes and $1,700 reduction in federal. Under these rules, you're going to get the Arizona reduction, but not the federal reduction. Would be the way the law works. You can't double dip. Now, to be an SGO, there are requirements. This is effectively an unfunded mandate to the states, but we'll get to that. So first, that organization must be a 501c3 organization, meaning if there's a tax on whether or not they qualify as a tax-exempt entity, then if they lose that status, you're in trouble. It must be exempt under Section 501A from taxes and cannot be a private foundation. Now, they have to segregate the funds. That means they have to have a separate accounts exclusively for qualified contributions to prevent commingling. So that status is there. Any qualified contribution, as already mentioned, the double benefit provision of 25F subsection E, cannot be taken into account as a 170 charitable contribution deduction. So in addition to not double dipping by taking the full credit, let's say for an Arizona private school credit, and then taking $1,700 against the full amount of federal, you also cannot claim an itemized deduction. So Schedule A is going to lose that amount as a deduction. If there's an excess credit in this case, right, our excess credit limited by Section 26A will be carried for up to 5 years on a first-in, first-out basis. That's true for this structure. Now, some other operation requirements for the SGO, the organization under Section 25FD of the code, is that the SGO must spend not less than 90% of its income on scholarships for eligible students. And it must provide scholarships to 10 or more eligible students who do not all attend the same school. So you can't set up an SGO just for one school, one private school. Going to have to be more than one school to qualify for this. There's also an income limit. The scholarship must be limited to eligible students whose household income does not exceed the area median gross income requirement. So there's an income test that has to be done. You've got to assure you're not giving scholarships to people with too high of income, or families that have too high of income. Also, This is one that was learned by Arizona rather quickly. An SGO cannot earmark contributions for scholarship on behalf of any particular student. I always thought, even in Arizona, that was a high-risk strategy because it would seem that could impact negatively your 501c3 status, because that looks a lot like private inurement. Yeah, especially when most scholarships are, directed. And in Arizona, they were even directing them to their own kid, which, yeah, that whole thing seems a little bit weird. And scholarships cannot be awarded to any disqualified person using rules that are similar to the rules for disqualified persons under 4946 of the code. So those are related to the organization in various ways. Now, there are state issues here. States must voluntarily elect participation and provide the Secretary, the Treasury Department, with an electronic list of compliant SGOs. This is the unfunded mandate. The states have to step up, and they're going to be responsible for monitoring these organizations and saying, hey, they're good. The state submission must include a certification under penalties of perjury. The state cannot rely on the SGO self-certification alone. That's not good enough. You can't just say, Arizona can't just say, okay, all you guys, tell us if you qualify for this. They'll say, oh, I swear we do. State can't then just send that test on. You're going to have to do some other checks, right? Request additional information, have other items involved, rather than just saying, hey, we self-certify, right? There is a 90% test for income, right? That has to be used on the scholarships. So the IRS anticipates proposing that income includes all income, including unrelated business income, and not just the segregated contributions for the organization. It's got to principally be involved in doing this, right? And they want to have some comments about multi-state organizations. How to apply the 10-student 90% spending rules in the aggregate, or is it on a state-by-state basis to organizations that operate in more than one state? Okay. Donor reporting. Anticipated guidance will require the SGOs to report taxpayer IDs and recipient eligibility to the IRS, right, on these. So in theory, the IRS will also have information, can go look at the recipients of their scholarships. They'll be able to test the income of that family and see if it looks like somebody's not really paying attention. So yeah, that's going to be an enforcement mechanism. Again, it's asking for guidance. They do want that. They do want that. Guidance. Your comments come in fairly quickly, but they're asking you to submit information on how they should do this. Remember, basically, the states have next year to set up their programs to monitor this stuff, and then in 27 we will have the first year where contributions would go in. Finally, yet another conservation easement and gross valuation misstatement problem. This in the case of Lake Jordan Holdings, LLC versus Commissioner, cast memorandum decision 2025-123. The opinion came down on November the 25th. Okay. Now, this transaction was a syndicated conservation easement that claimed over 157 acres in Alabama. So looking at, they're granted a right, a conservation easement on those acres in Alabama. Now, that land was purchased for $583,000 only months prior to the claim deduction. The deduction for donating a conservation easement on that land they had just recently purchased, $583,000, was claimed to be $12,740,000. The court basically there just immediately was like, yeah, do I believe what seems like would be the reasonable amount that could have grown, or am I going to just suspend disbelief and accept these magic numbers they're kicking out? The promoter goal, they had a goal, they had a model that aimed for the hypothetical highest and best use, around 10 times the cost of the land, to ensure a higher return for their investors, right? And obviously, the problem with that economically is, how do you acquire land, right, for which you're going to make this easement donation? That is, you're buying today for whatever the number is you're buying it for, but where the valuation of the easement will be 10 times what you paid for all rights related to that land. Economically, it doesn't make sense about why to go up that much. And as I tell people all the time, it also makes economic sense why you just didn't have them sell it. If it's worth 10 times what they paid for it now, and there's a buyer who's going to pay that number, just sell it. Right? I mean, I'm charitable, but at a certain point, it's like, who cares? Just sell it. Right? Sell it for whatever huge value it's now worth and pocket it. And then you can be very generous from that money later. But yeah, in the real world, you would sell this land. Well, the IRS in the exam, of course, came to the conclusion that, yeah, that number's crazy. It's not quite that quickly, but it certainly gets your attention. And they disallowed the deduction and asserted the 40% gross valuation misstatement penalty. Remember, that penalty, you cannot get that penalty waived for a reasonable cause or reliance on the advice of an expert. So we're going to take a look at technical compliance versus the valuation's reality. On a technical side, the court didn't have problems until we got the value. The court rejected the IRS's position, which they've tried multiple times in these cases, to argue that tax motivation totally negates content. That people were doing this for the tax motivation, that was the benefit they were getting. And noted, they said, look, objectively, there was a perpetual easement donation defeats the claim, and Congress clearly wants to give a benefit to people making that donation. So as such, the fact that they did it, they made the donation to get a tax benefit is a no-brainer. That's what you do. They actually gave up the asset, right? They gave up that use of the asset, and they did it for a charitable contribution that Congress recognizes. The tax court's not buying this theory. I mean, I understand what the IRS is saying. These people are just looking, going, wow, I don't care why you get that deduction. I don't care, charitable or not, who cares? I just know I get a 10 times deduction versus what I put in. Well, it wasn't quite 10 in this case. It wasn't 10 in this case. They brought it down some for safety, they claimed. They still lost it. It's like, but that is how it's marketed. But the commissioners, the tax court said, we're not going to trigger it for that because Congress intended for there to be easement deductions made, right? The court held that the deduction was properly claimed on the second short year return, despite the complexity of 708B1 and technical termination rules. Yeah, because of having things been purchased there, technical terms were still a thing. There was a kind of messy which date, because, was the date of technical term the first day of the new year or last day of the old year, because contribution went on the first day of the new year. Well, they claim it was the first day of the new year. And if it really would be the last day of the prior, would only be the last day of the prior partnership under a technical term, then that would have been a problem, because not the right beneficiaries, not the right partners would have gotten the deduction. It would have been on the wrong return. But the court found that was no problem. It said, now we're okay with that. And now if you hadn't technically adhered to these rules, it would have blown the deduction. So good news, following them does mean deduction is possible, but that doesn't shield you from the penalties related to grossly inflated value. The quality of valuation is what's losing every time in these cases, right? Again, we have, we're going to do this. Now, the way you do these, because usually we aren't selling conservation easements, so they use a before and after method. What was the value of this property before we made this contribution of an easement? And what's the value after, right? Before and after. Now, but the court said the problem becomes, what is the highest and best use of the land? That is what you do use when you're valuing land under these methods. What would be the highest and best use of the land, even if it's not currently being used that way? And the proposed highest and best use would be 157 lot lakeside residential community was rejected. The court found that given the facts on the ground, what's happening there, it was both speculative and improbable that this theoretical development would ever have been able to take place. The evidence against that being highest and best use, it was a rural, very remote, very challenging topography, very remote location, poor access to the location, right? And the recent arm length sale of $583,000 all contradicted a high density development, highest and best use. And it was bought from people who are in the real estate business. Why in the world would they have skipped this development? How could they have not thought of this? It was such an obvious thing to do, right? They accepted the highest and best use to be the low-density recreational developments on the waterfront and recreational use for interior acreage, right? Now, they also rejected the cash flow method that was used to value this by the party. It found their discounted cash flow analysis yielding $7.4 million was rejected as inherently speculative, unreliable for vacant land that had no income history whatsoever. We're not going to do that. We're going back to comparables, right? Take a comparable sales approach. They decided the correct before value, which still went up quite a bit, be $1,376,760. The correct easement value then took that value, and the court decided that the land was now worth $285,000 with that restriction put on it. That gave us a contribution of $1,091,760, which is not quite twice what they put initially, but that's not going to pay for your tax side of it exactly. We end up taking that deduction. 37% of that is going to be less than 50% of that. And even if you have a state in there, you're still not going to quite get the amount you need, right? So what they said was, whoops, we get back here, right? So what we've got here is, so we have that. Now, the IRS attempted to say there was a civil fraud penalty here too. They're trying to cheat us out of money. And the court said no, because the partnership did disclose the transaction by attaching Form 8886. So it said, trying to say they were trying to conceal this transaction. That's a poor fit, because why would you, if you're trying to hide it, the last thing you do is file the listed transaction form, right? And say, hey, we're one of these things. They're saying, so we're not accepting that they were trying to defraud you, because that requires basically one of the badges of fraud, and they just aren't here. They were not actively concealing what was going on, right? However, the gross valuation misstatement, the claim value of $12,740,000 for this conservation easement was 1,167% above, more than the correct value, well more than 200%. As such, 40% valuation misstatement penalty applies. And as we've talked about in prior weeks, this is not subject to reasonable cause defense. You got to pay. So in addition to not only having to pay back the tax deduction, the taxes they got, reduction in taxes they got, they had to add additional 40% to that, making this an even worse payoff. If the only real benefit you had was a charitable contribution, you had a basically worthless piece of land otherwise. Yeah, this was not the world's best investment. And they lost out on it. So this has been the current federal tax developments for the week of December the 1st, 2025. As always, brought to you by your state-sized CPAs. If you have any questions, you can email me, edzollers@thompsonzollersandlynch.com. I also do take a look at the Connect sites run by the Arizona Society, the New Jersey Society, Illinois Society, Minnesota Society, Idaho Society, and Washington. And also, you can, as you say, find our daily updates as things happen. You'll see the write-ups that I post every day on key cases on the current federal tax developments.com site. So we get those up there, get them together, get them summarized, get them posted. So you have the summaries of cases, can cut down the size a bit so you can look at what's going on. Otherwise, I should be back next week. Welcome to the last month of the year. Right? It's tax planning season now. Hopefully you're getting involved with that with your clients at this point. But in any event, we will see you back next week for more current federal tax developments.